Good morning, everybody. Welcome to the Flow Show. Morning, Kay. Morning, Stel.
Good
Hello,
morning.
hello.
How are we doing,
Good
lads?
morning. Not bad. Same old new.
Yeah, bit of a quiet one this morning. I'm knackered this week. I don't know why. Absolutely knackered.
Is it
this
Friday
week.
yet?
Age.
I thought it was Friday today, yesterday. No, it was only Wednesday yesterday. Gutted. Yeah. Oh, funny, strange week. Anyway,
Yeah.
this is what we're here for. So we deal with it as we do. Okay, let's get stuck into things. China may cut the RRR this year to expand the liquidity supply, according to analysts in the China Securities Journal. We've had some talk they might cut the RRR second quarter, first quarter, second quarter sometime. That's still being touted around. So far, they've refrained from doing any major changes to any of their rates. But they are pumping more fiscal measures potentially to come, as mentioned yesterday. Some strange goings on in the Aussie-China relationship. China's Ministry of Commerce said China and Australia can solve trade issues via dialogue. Things were supposed to be getting better, but news out overnight about a shipment of coal that had to divert to Vietnam because it spent, I think, over 5 days waiting customs clearance in China. That obviously dragged on and they rerouted the ship. So not sure that everything is going as swimmingly as perhaps we've been led to believe. And, you know, this could be another case of China speaking out of both sides of its mouth. You know, they've made all nice noises towards the US and everything else, and then they send over spy balloons. So, you know, on one hand, they're talking a good game. On the other hand, they're still up to their old tricks. So not sure what's going on there, but the Aussies and the Chinese are still talking. We'll see what comes of that. Over in Japan, and one politician citing Chief Cabinet Secretary Matsuno said there was no information leakage in the BOJ governor nomination process. Nikkei must have just made it up as they went along then when they dropped that bombshell about Ueda. It's been confirmed that the lower house of parliament will hold a confirmation hearing on those new bods on February the 24th. But there's been no decision yet on when it's going to happen in the upper house as well. These formalities are probably where we're going to hear from Ueda and some of his comments when he gets questioned. Until then, he has been told to keep his mouth shut, apparently, until these hearings. So we're unlikely to hear anything out of him. Now, the Bank of Japan raised rates. Bit of a shock for you. Actually, they raised rates on the minimum fee they charge on one of their programs called the SLF. This is a sort of and part of their operations, and I don't understand it fully myself, where it's a program where the bank offers JGBs out to market participants. They're now raising the fees charged on that from 0.25% to 1%. I say I don't understand wholly what it all means, but if you take in the bigger picture, it's another sign of something creeping up in price. So the Bank of Japan did say that they've seen massive short selling on some of the on-the-run 10-year JGBs on the assumption that the SLF is to be used longer term. However, this program is more of a emergency or short-term liquidity measure. So not sure what those short sellers are doing. Just to clarify, on the run bonds are the latest issued bonds. So they deal with whatever's been sold in the market or auctioned at the most recent. Off the run bonds are all those bonds outstanding prior to whatever the previous sale was. Kay, you've got any ideas what's going on here? I'm not sure it's anything big, but
well, I mean, the thing is, yeah, they've said that they were putting temporary measures in place and that they were going to, and I think they actually lowered this rate before, and then now they're putting it back higher. It's probably a sign that that they are showing that they are not going to be there forever at the cheapest for the market. But so the market tried to take it slightly positive at first when it came out, but then it seems that really it's a non-event basically. I don't even know how many candidates were there to take up this SLF. I'm going to say I don't know really on this one what to think of it.
It seems more like a bit of a market function move, you know, a bit how they spun the YCC change, just to help the market function rather than monetary policy moves or anything towards monetary policy moves.
Yeah, I don't know if Stel has more on the technical aspect of this, having traded bonds before and so, but I must admit I'm not knowledgeable in what it would really entail flow-wise, you know.
Yeah. Stel
is not there. He's gonna surfing for a while you're doing the news update.
Yeah, he's got to put the kettle on. 2 sugars, please, Stel, if you can hear us. Right, well, until he comes back, there's been a fair bit of data out overnight as well. Aussie employment maybe the pick of the bunch and a bit soft on the numbers there. Employment change down 11.5k versus 20k expected. Full-term employment change there, falling 43.3k. Unemployment rate jumped 2 pips to 3.7%, and that comes as the participation rate dips. So a sort of double whammy there, but not good news from Australia on the jobs numbers. Some Japanese data as well. Let's see if I can find it down here. Not good on the trade balance numbers, but they're still a bit all over the place, in my opinion. Machine orders month on month up, but not as much as expected. Year on year down a bit worse. Looking at the trade data, still exports now down, or sorry, up, but not running as hot as they were before. We've seen some quite big numbers in the import and export numbers, as you can see from the import numbers, 17.8%. So activity potentially slowing a bit in January. Could just be New Year stuff. Last year stuff.
It's a bit of it's a record number actually, yeah, for the negative trade balance. So in on the face of it, it's bad. But then if you look at imports and exports up, we could understand that it's a bit positive activity, but the imports are probably due to perhaps people waiting for the worst of the energy to be over and then starting to buy it again on with slightly cheaper prices. But yeah, I don't think it's a very good number all in all. If exports would match the imports, that would mean that stuff is going better in Japan and they can export again thanks to a weaker yen overall. But that doesn't seem to materialize. And then on the core machinery orders, yeah, you know, Japan is a big producer of heavy machinery as well. So it is a fair little part of their economy. So having this number on the year-on-year dropping again is not a very good sign. But then yen didn't really react too much, and then same as you were saying on the Aussie, it had exactly a 15-minute dip, and then that was it. And then the Aussie started to go higher again. Why? I don't know. Perhaps a bit of just following. I think a lot of it has to do with the correlations now as well between. If you look at this morning when we woke up, the commodity sphere was all in the green. the equity markets were all green as well. So that may have to do with the rebound in the Aussie. And then the technical one, yeah, around this 68, 70.
Yeah.
I thought yesterday we were breaking some trend line there on the way down around the figure and all. And so I was a bit short against it, but then overnight I woke up and I got taken out. So I had a very small one left over, so got taken out. I don't really know why. I think the fact that US 10s perhaps are not holding the 380 line, people are selling back a few dollars. But it's all pretty much in the global picture going like as I assumed it may be going, right? So the equity is not falling out of bed.
Yeah.
And we're still trading that soft landing, and then you're going to see very uneven moves in FX, because on the one hand, can't be short dollars because of the yields are going up there, but then yields are also keeping up elsewhere, and if risk doesn't fall out of bed, the correlation algos will have to actually sell dollars a little bit, because that's the way that risk on goes. But yeah, just over the data, I don't particularly like what I see in Japan right now, and Aussie were a bit of a mystery, because it's a pretty well, in the actual numbers, looking at the size of Australia, it may not be a huge difference, 30K versus the expected, but it's a negative number, and also the full employment change is pretty negative. It's all full employment, right? That's been lost. So I'm a little in doubt why Aussie is back up. Versus dollar is one thing, but it's also a bit stronger on the cross side, which I don't really understand why.
Yeah, and the Aussie stuff, it has been a bit mixed. Same with the Japan stuff as well. I mean, you look at the trade balance data, and it's been horrific for a while on one hand, but it does swing around a lot. And like you say, when you look at things like trade balance data, there's two things you can look at it. Obviously, whether it's a surplus or a deficit, that's obviously important. But in this case, it's the activity, and I always look at the numbers. If even though you could get a worse trade balance because you've got bigger imports than exports, both numbers are hugely positive, which means there's activity. So in one sense, it's good. If you've got imports, it means people in Japan are buying stuff. They're spending money and buying stuff, machinery, whatever the goods are. And so you get a sense that there is activity. What you don't want to see is trade balances falling when these numbers are negatives and it's showing a lack of activity, because that's when you start getting right into deep recession territory, when activity really drops off a cliff and there's no buying or selling. So there's always two sides to look at trade data in terms of what a surplus or deficit is and whether there's activity or not. That's something I always look at in these sorts of numbers. Coming into some of the other data today, we've had a few bits and pieces out, not too much. Some more trade balance data in Italy. And really, the data today, we're going to be getting more housing data from the US. Some of the main numbers now, building permits and housing starts. And just coming across to that, we saw a pickup in the NHAB housing market index, which had been cratering for several months. And now it's picked up the last 2 months on the trot. That was February numbers coming in at 42 versus 37 expected and 35 previously. So beginning to see maybe a bit of a turn in the housing market. Could still be just a bit of a new year bounce, but that's two positive numbers from the NHAB housing market index. Although the MBA yesterday was a bit weaker, it's still only posted its second weakest week in the year so far. So we've had plenty of plus numbers. There is signs, perhaps, as I say, that the housing market may be looking to bottom out from what we saw pretty much the whole of last year. Whether these numbers start to reflect some of these weekly data numbers, I'm not too sure. But to say, I would not be surprised if we start seeing the main housing numbers maybe showing a bit of a turn, a bit of a pickup. But as I say, we have to see whether that's just some new year optimism, or whether it's a start of a trend high and more soft landing, no landing numbers to go in the mix there. Philly Fed gives us a second look at manufacturing after an improvement in the Empire State yesterday. It didn't go into a positive. Let's get the numbers up for you. It didn't go positive yesterday, but it wasn't as crap as it was the month before, coming in at minus 5.8 from a minus 32.9 prior. So remember, we got a big drop last month, so much improved there. I'll have a look at the retail sales in a moment. I'll just chew through some of the other numbers and headlines at the moment. UK PM Sunak is going to have a chinwag with von der Leyen before the end of the week, apparently. And then the text of this new supposed negotiation with the Northern Ireland Protocol is going to go before the DUP on Monday. That's the Northern Irish Party, who has been the stick in the mud regarding getting the deal done. Rumours, as mentioned yesterday, is that all their conditions have been met. So that's going to them on Monday. If they give that the thumbs up, then finally we may be heading to some sort of resolution on this Northern Ireland Protocol business, which has been dragging on forever. Never say never with these lot, though. We could get to Monday and the DUP go, oh yeah, it's all great, but, and then we're back to square one. But it looks like maybe some headlines early next week.
Yeah, and I suspect that if they find an agreement, it's probably something that was already in the text on the, what is it, 22nd of June 2016.
Yeah.
Just coming back to square one and say like, oh, finally we're going to sign it.
Yeah. As far as the pound is concerned, though, I think it's all baked in. At most, we might see a small confirmatory jerk in the pound, but the market knows it's been heading in this direction for a while, so I'm not expecting any huge moves in the quid. Never say never, of course. Always there to be surprised. But as I say, we've been hearing this for ages. The Bundesbank's chief economist, Ulbrich, says we will see very strong declines in housing construction and investment this year. Good news coming for Germany. ECB's Lagarde says there's no signs of a self-sustained wage spiral. She was speaking at a plenary session yesterday. ECB's Panetta may be having a little dig at his boss, saying the ECB should not unconditionally pre-commit to future policy moves. You'll remember Lagarde touting 3 lots of 50 pip hikes 2 meetings ago, which we're in the midst of now. He said he must now consider the risks of over-tightening, and to move in small steps with interest rates does not mean to move less. We will continue to tighten. Reuters picked up the phone to a bunch of economists about the ECB and their rate thoughts, and all 57 economists polled expect the ECB to add 50 BPs to the deposit rate on March the 16th, so taking it to 3%. The ECB will raise the deposit rate to 3.25% in Q2, said 26 of 56 economists. 19 of those said they will go another 50 pips up to 3.5%. So all those still looking at hikes from the ECB. Right, let's have a look at these retail sales. Goldilocks numbers again, fellas. Quite a surprising jump. Some people touted this based on the weather. Some people touted this based on other bits and bobs. But still, it's a very strong number. I think if you flatten it out between what happened in November, December, which was really poor, it's a bit of surprise that the dollar reacted so much, because it sort of evens out, doesn't it, guys? You know, we had a crap couple of months end of the year. Now we've had a bumper January. You know, what's behind it?
Yeah. By the way, Stellas had to leave because he had to pick up his daughter from school. He got a phone call apparently. So Stella won't be with us for the rest of the flow show. It evens out, but I would argue that the market was looking in its fight against the Fed or its doubt versus the Fed, I think the market was looking or hoping for numbers as sanguine as it may seem, hoping for numbers to show the slowdown and tell the market it's right to expect slowdowns. And my takeaway from what we are seeing over the past few numbers is that we are not there yet. So I don't think we have to look for that. So the market, and that's where we are repricing those yields and stuff. And I think that's kind of the message that's behind. So, but actually, if you look in terms of moves, it actually flattens out, because you had this end of the year, start of the year move lower in the dollar, and now we are more or less back to where we were before, right? Around 107.
Yeah.
Oh, perhaps dollar yen. Well, even dollar yen is 134. Call it. We're not that far. Yeah, I think it's yeah, the market has balanced itself out a little bit over those data. But it's, I think those data that we are seeing now, they are going to they will have to drive the bus. And what we are seeing, I think, is pretty much what I've been talking about a good number of times. Is it's not necessarily bad for some assets like equities and so. I'm actually a little surprised, but that is probably flows, that the metals came back that much. But I think that's just Russia, China, Turkey demand that has waned, and those who were in the know, once they saw that they stopped buying, they took profit themselves. So there the moves may have been accelerated and exaggerated a little bit. But if you look at now where you were there, gold. Yeah. Get back to it. Well, look at the end of the year. Look at the end of the year where we were. December, the last few weeks of December, we were turning around 1800, 1825. Then you had that vicious spike higher, and now we need to reprice, and we are roughly back to the end of December levels, right? So if you look at it in a more medium term, it all makes relative sense.
Yeah, no, I agree with you. Because I think, I'm reading, just watching Twitter this morning and comments from yesterday and the retail sales, and everyone's gushing, oh, the US consumer's strong and everything's, fine and dandy. Well, where was all this spending in November and December? The two of the most busiest retail months of the year. They weren't there. So where's all this money come from? They suddenly found it under the sofa. There have been some talk, analyst talks, because there were some changes and rejigging of benefit payments, unemployment payments, and things like that. And much like the NFP, it's been a Goldilocks number, and I think there's some risk that maybe the next set of numbers we get are going to wash some of this out.
It is possible.
So yeah, I think if we get another bumper number in jobs and things like retail sales next month, well, maybe we have got something different on our hands. But I think there's a risk we see some sort of washout of these numbers, and then the market's going to all of a sudden have the rug pulled under it, and maybe things won't be looking as rosy or as hawkish, and we go completely the other way. Yields back down, dollar back down.
Yeah, that's why I'm saying, like, and after the central bank meetings, the major central bank meetings last time, I was saying exactly the same thing. People can talk about it, people can write books about it, but there's only two words that we had to take away: data dependent. And so if they are data dependent, we have to be as well. So now the data are good, the dollar has strengthened, risk is still doing okay because of good data. And that's where we are. We are data dependent. If they turn sour again, we shouldn't be fighting them either. We have to really be flexible right here and now. And it's easy to say, and we all want to trade and do stuff. but really, I mean, data are important. I can't stress it enough. And what we are seeing now is what I've been talking about. It all makes relative, well, relative and or even perfect sense. The data are better. Dollar is a bit stronger. Dollar yen is back to 134. Euro dollar around 100 and 107. Cable from lower from the highs, but those moves are not are going to be uneven, but the levels are still there, because if I just spoke about cable, I'll have a look at it, but maybe you can have a look at it as well. But this 119.6580, also call it, it's a relatively important zone, because that is where we bounced from last time to 122.60. And if you look at it over time, even before we started this year, it's always been a bit of a traffic zone, right? I like this 119.6580-ish as a point of measurement for strength or weakness, for instance, on the cable. And it does make perfect sense, because if you look at sterling being a bit of a risk currency as well, it makes sense that it holds down there as well for now, because risk is not falling out of bed.
Yeah, exactly. Mike asked the questions. People said statement. People were waiting for January sales. Well, what about the Black Friday sales, Cyber Monday sales? You know, what about putting food on the table for Thanksgiving and everything that goes with that? You know, no one gives Christmas presents in January. So yeah, people might wait for sales, but you know, it's a big retail period. You know, who goes out spending in January? Everyone's supposed to be skint in January because they spent everything before Christmas and stuff. So those sort of things ring bells. But you know, it may be right, because I've got my own experience here where I live. You know, I think I mentioned it a few weeks ago. Second week in January, went out on a Friday night, just with a wife down the local high street, everywhere packed. And I'm talking jam packed, couldn't get a table packed. Bars, pubs, restaurants, for the second week in January, when supposedly most people are usually skint. I remember what it used to be like when I worked in the city, when I was young, free and single, blew all my money before Christmas, skint over January, because I was out too busy partying over the Christmas period. And you know, you tightened your belt in January. Now it seems everyone's out and about. So yeah, it might be real, it might not be. All we have to do as traders, our only job is to know where the risks lie. If the data's good, we carry on going with the trend, stronger dollar. If it's not, the price risk is then that all stops and it goes the other way. And the good thing about being a trader, being a retail trader, you're not a bank. You don't have to. You don't have customers. You got a Koto too, so you can change your mind faster than they can. You can move with the data faster than they can. You can trade the changes in the data faster than they can. So you don't get married. Right now, we're in a hawkish position. All the banks are raising their forecast for peak rate, Fed yields are going up. You see it. You trade with the trend. At the moment, we're in dollar dip buying mode. Two crappy bits of data, we're in dollar rally selling mode. You've got to know when to change. You've got to know when the market sentiment changes, because if you keep following the old narrative and you're still buying dips into a rally selling market, you're going to pay money. You're going to lose money on it. So you can't. You've got to be ready to flick your switch in how you trade and go the other way. Don't let your bias take over what the market wants to do. Any more headlines? The last headline really is that from the Fed, that Chicago President Austin Goolsbee is in consideration to replace Brainard when she becomes Biden's economic advisor. He's been a bit quiet since he took over at the Chicago Fed, I think a month or two ago. Hasn't really said much, not really heard anything from him. But he's set to step up apparently into the hot seat as vice chair, and he'll definitely have to open his gob when that happens. Right, let's get stuck into the charts. I'll let Kay talk about cable in more detail there. One thing I want to highlight, a little lesson for you all, that even when you've been doing this game as long as I have. You can still make stupid mistakes and not follow your plan. Those of you who are regulars to the Flow Show will know I've been saying for probably 2 weeks now, we need to get above 70 and hold above 70. If not, we're going to see the downside. And we saw the downside. And I said, when we see the downside, look for a break, but look for confirmation of a break, more so than going with an initial move. So what did I do yesterday? I went with an initial move and pretty much sold the low on a sell stop, which I've chucked in for a 25 pip loss thereafter. So rather than waiting for this to break properly and then maybe come down, bounce and confirm this area as resistance before getting into a short, I just threw it all out the window. Why did I do that? A bit of FOMO. I didn't short up here on the failures at 70, even though I said a failure would likely lead to the moves lower, and that happened once and that happened twice. And in the data yesterday, some of the guys in the room jumped on shorts there on the back of the retail sales data. I missed that move, and so I tried to do the clever thing and trade a break. So I got my just rewards, a 25 pip loss, which I wear on the chin. That's the way trading goes. And a black mark on my card, must do better next time. Kay, you managed to grab a few shekels out of that one.
Yeah, I sold the break of 69, the figure, and then luckily took half back on the way down to 70, because there's some levels down there as well, and yeah, got done on the rest walking in overnight, walking in this morning. So it's all in all a bit of a zero-sum game.
Yeah.
But yeah, I mean, sometimes it happens, you know. We are human beings, we are not machines. So we do have our view and our sentiment, and sometimes a bit trigger happy on moves, and those things happen. So
yeah,
we have to just manage those small hiccups in the lot, and it's all right. I mean, actually, it's all right. Because if you see the break, and we're trading 67.5 this morning, or low 68s, we are going to say like, okay, we traded the break and it worked. Sometimes you want to trade a break and it didn't work. Okay, yeah, that about this Aussie. I'm just looking at the chat. Ali says short euro dollar. Unfortunately, I wasn't able to close 50 also. Yeah, I mean, yeah, the 106.60-65 is a bit of a zone there, but really we are not traveling too far from ranges and stuff, right?
Yeah, I think that's the key thing, and you know, for the Aussie, it's confirming the short-term range. You know, up between 70 and down to this 68, 70, with you know some little extensions now and again, depending on the news and headlines and whatever. But largely, we're staying in the range. That's not going to last forever, obviously. So the prospect of getting a break either side is going to happen eventually. It's just a question of which way it goes. At the moment, I'm still a bit more bearish short term this one than bullish. I've still got my long-term longs, and I'll start thinking about tightening my stops up if we get a break under this level. But we do have a couple of zones down into 68s, 67, 70s, and then down into the 67s down here. So we start hitting those fibs. Might be time to think about that the trend since October is maybe starting to turn. The 50 fib will be the most important one for me. It always is. If we break that, that's a definite signal that the trend is pretty much over. The 61.8 is the sort of last line in the sand for that, but it will start looking very much weaker if we get below that 50 fib. But a long way to go until then. Ali, you sold Aussie dollar yesterday and booked 28 pips. Very nice, my friend. Stick it in the bank, mate. Stick it in the bank. Nice trade on euro as well. Let's get zoomed in a bit there. Again, I probably need to do a bit of tidying up with my charts, but yeah, we're holding. We had that test of the 108 held one of the levels. We were very close to it, so I wasn't I wasn't fast enough, and I wasn't keen on trading it that close to it anyway, but it held. We are getting a bit of a low, as Kay pointed out, into the 50s, 60s down here, bit of a bottom forming around there. So that's your marker for the downside. And I think that for the near term, yeah, it's a bit of sideways action. It's similar to the Aussie. Watch these lows down here. Watch the 108s up there. Try not to get too caught up in the middle. There's enough room there to let the price roam around and see where it goes and get into some profit. Just to go over some of my other positions, $1 still ticking up nicely. We're now looking like we're holding above the 684, which is good news. Maybe we get a push up to the 690, 91 level. Got a bit of a minor area in the 88s, 89s, so I'm keeping an eye on that one there, but all good for now on that one. My other trade, Hong Kong dollar, having a little flirt around, keeping an eye on the intervention. There was a headline out that the HKMA have plenty in the bank to keep marking the moves they get at the top, so intervening, and no let up in that for now, so long that may that continue. But as I said before, this is one where sometimes you do have to sit in it and just let it do its thing. But I will be still looking to add back in what I got out at this 784.5, adding back in there, and I'll be playing hopefully the bounces up and down between that level until something changes. So that's what I'm going to be looking on that. Mike says, I believe that AUD trade more on risk on and iron ore price. Yeah, you know, it's a bit like CAD and oil. Obviously, the Aussie dollar is a very commodity strong currency, so you always have to keep an eye on that, what's happening in those commods, for some idea of what's happening with the Aussie dollar. It's another one of those correlations. Sometimes it's really strong, sometimes it's not. So you just have to know what wind's blowing at any one time. But as Kay mentioned, we are seeing very strong stock performances. The FTSE smashing through, if I can find it, where are we? FTSE smashing through the 8K number now, really starting to motor on that break above the high 77, 78s. So sky's the limit for this one. A lot of this been driven by some of the energy companies. Centrica, who owns British Gas, posted booming profits at the misery of all their poor customers paying through the nose for it. But such is the market. So stocks really rallying higher there, and you know, the same situation for European stocks as well, all moving higher and keeping their gains. CAC looking up towards its recent big highs. Similar story across the globe, really. You know, bounces in stocks pretty much everywhere you look, and that theme is staying in place, and it's catching. You know, the retail sales was good, and we largely got a bounce in the S&P. Did have a little look at the big figure at the 41, and then pretty much reversed that straight away. We talk about stocks a lot and looking for this switch between good news is bad for stocks to whether good news is good news for stocks, and I think that's happening. I think it's a pretty slow process in US stocks. Do you think, Kay? We may be seeing it faster in Europe and elsewhere, but it's still like the old people are still trying to cling on to the old ways and not quite ready to let go of them.
Yeah, but there may be a bit of, you know, rebalancing going on between the one and the others. Higher yields, maybe less attractive to stay in faster stuff. So you go back in companies that make money, and as you say, that's been happening in stuff like the FTSE, for instance. That's what we have seen in stuff like the DAX, for instance, as well in January. And I still don't recall which company it is, but one of the big investors has been buying some FTSE shares as well. I think they bought about, what is it, 5% or so of Vodafone, is it? I still haven't found the article back, and I forgot to look for it. But yeah, I think, but that's the thing. That's what I've been saying as well since the start. I say be careful, because everybody says like, oh, good news is bad news for stocks. Well, when your economy is doing okay, when your data are okay, why would it be bad for stocks?
Yeah.
It's not something. It's not, the stock market is not square on money. There's always new money coming in or money flowing out, as we see at times, but it's not square. It's not the same money who buys and sells all the time. It's just when people think, oh, the data are pretty good, well, let's invest some. And since people are very, I mean, they are more knowledgeable or more
In
how should I
tune.
say, more attracted to equity markets with their, in the States with their, what is it, their 401, in the UK, what is it here, the ISA also,
Yeah.
is it ISA or ISA or what is it here? And you've got a lot of stuff in a lot of countries, and when people see that the data are pretty okay, well, they will invest. They will put 10% of their salary into equities, and all those flows make that the market is just holding up because of the good data, and they need
Yeah.
to. And they want to find some return somewhere. So you buy stocks, but okay, just in the global picture, and I've been saying it straight away after the central bank meetings and the jobs report, and I was saying if this market trades a soft landing or no landing, it's not going to be bad for stocks. But then you will see uneven moves in the dollar. The dollar is probably going to appreciate because of the yields are high, because of the yields being higher and the Fed higher for longer, but it's not necessarily bad for stocks. So
Yeah.
that's exactly what's going on.
I mean, we set this out really at the start of the year, this potential change, and it's happening. As I say, I think it's just happening a bit slower in the US than it is elsewhere. But that could mean we see a bit of a catch up if this data continues. The market's going to start jumping into stocks again. So we could be going back to those all-time highs. Who knows? We should wait and see. Just as we sit here, China's top leaders have apparently declared victory in COVID control. That's dropping on the wires there. So all done in China. COVID's behind them. Rear view mirror. Nothing to see here. Let's see if the ones gained a bit on that. Not really. So nothing market moving that I need to worry about on that one. Okay. Do you want to do your little rally around?
Yeah, sure, mate. Yeah. Hang on. Just one little sec, please. Okay. Right. Ready. Oh. Yeah, I'm ready, Ryan. You can release whenever you want. All right. Let's have a little look around. Gold. Yeah, bit of support here in those low 1830s. As I was saying, when you look at those moves, we had this big rally, and we heard in November, December, January that China and Russia were buying loads of gold. I suspect that they said, okay, we've got enough in January, and then with the US data, this thing it came back down quite rapidly. So we've got a bit of a level here, which is the 38.2 of that famous end of year rally. And that's low 18, that's 1830 basically. And then the rest will be, I think, if we go any lower, we're going to have the battle for 1790, 1800. If ever seen there, this is going to be a pretty important zone. If you look at this 1787, 1787, 1788, here the low from inside the move as well. It's all going to happen if ever we get down there. That's going to be big decision time, in my opinion, if it gets down here. If stuff starts to turn around in the very short term, I'd keep an eye on what's happening just towards the 1860 area, perhaps. But the big zone is going to be the 1900, of course. Again, I don't know what to do with this because I'm a little bit torn in between. If the economy continues to do well, and this could be a case for metals to do pretty well. But then if inflation remains sticky, as we have seen, then it's a different story. This one, we are below 22, so I'm not going to be in a hurry either on silver, but I'm going to be keeping a very close eye on what's happening around 21, because if the data are good, if Brainard is a dove, but that translate if she's becoming the economic advisor for Biden, that could translate in advising Biden to push through with spending programs and stuff. And if construction and if infrastructure is part of, as we know, part of this whole deal, this one I think should at some stage find the bottom. But is it at 21? Is it at 20 or as people say 19? I don't really know for now. So I'm trying to be patient, but I'm going to be less patient if we get back above 22, 10, 25. I think that if we get back above there, I may start to try at least add to my very long-term longs. Yeah, euro dollar. Seeing this little zone here, market likes to jump on it. It's been the average trading range low as well for a couple of days. So more than being a strong fib or whatever, I think it has more to do with people watching those ranges and just the fact that it's holding. Yeah, this one is going up, but I do think that the bigger test is what I said before is rather going to be here around this 105.80, 106 the figure. I view this as a more important level of this trend line perhaps. This is creeping up a bit too fast for my liking to really get important. I'm not trading much of the euro dollar right now. Just a couple of stabs. 108, the figure is going to be the level on the way back up. So we've got about 130, 140 points to play around in right now, because it makes it hard for me to trade the euro dollar because I have one idea on euro with the ECB and risk and stuff, and then I've got a different idea on the Fed. So I mean, I've got pretty similar idea actually on the Fed. So if for me it's tough to trade the euro dollar, I prefer to trade stuff like dollar yen, for instance. So the dollar yen broke through the famous 132.85 figure, and we traded up pretty close to the important zone again, right? And we just stopped. Also, as our friend in the room, DK, said, the average trading range was up at 134.30 something, and we stopped right there. Interesting though is that two retests of 136.60 are giving us a little bit of an intermediate level to look at, and it held again this morning. Before the bigger zone of 132.85 figure. Top side, well, I mean, it's clear, right? It's very clear. It's 134.5, 135 again. There's nothing else to watch on the top side. If this breaks, then we may be talking about 138 again. On the daily, people are watching this 200-day moving average, comes in at around 136.85, could be another target if the dollar continues to rally. And now that it's got a little bit quiet around UEDA, we can actually, unless the market goes bananas on the JGBs, and unless the US yields start to tank again, I think this looks still constructive. For as long as those US yields are holding, and perhaps pushing through. Yesterday, I've noted this 383 level on the 10s, and it's roughly where it stops right now. It's the 50% of the corrective move that we saw at the end of last year. all the way from the highs down to the lows. The 50% comes in at 383, and it's been a bit of a traffic zone before. So keep an eye on that for an extra guide on your dollar yen, I'd say. But for the time being, for as long as we hold 132.85 figure, also, but I think this is now starting to move. No, we're still, yeah, you see it's a bit lower today, right? Where is, yeah, it's already back down to, where's the bottom of the cloud here? 132.60s. Yeah, it's moving down, but yesterday it was around that 133, and the Japanese accounts like to trade a little bit of a Ishimoku cloud. So as long as we're in the cloud, there's perhaps a possibility to go and test the top end. And if you look at how the moves are developing, this could become very close to the 200-day moving average. So keep an eye on that one. They could coincide and create a confluence in dollar yen to, if we ever get there. It's another 250 points from here, but in yen we can do these kind of moves. So that for the yen. Yeah, then I was looking at cable. We've got a bit of like intraday levels here. 120, 75, 80. And on the downside, as I said, I'd like to respect this 119.80 zone, because it's always 119.80, 119.65. It's always been a bit of a level where there was a bit of interest in the past. So this could be your judge for strength or weakness if it would ever break. Then I think we can see an acceleration in the cable lower. Euro sterling, I don't know how much the influence of this Northern Ireland package can do it, but we may be forming a bit of a head and shoulder here if we fail to get above 89 again. And then that means that we are going to sit in a range here of about 100 points, 88, 89 in my opinion. So keeping an eye on this for the euro sterling. I'm still running my option. For me, for as long as it moves up and down through 88.5, I'm happy. But being a little underhedged, I still think there's a chance that this may trade higher over time. But let's see. For that, dollar makes still, where are we? 1858. We're still hanging around there. We're still not breaking it. If ever this would break, this 1842.50, the next one could be just 17.5 with an intermediate station around 1780s. But there's probably a few percentages to make if it breaks. Yesterday we tried to rally, but more than 1% there wasn't to be made from the lows. So now we're already back. Not really weighing on this, but we're already back to close to the big supports. And looking at the lack of big bounces, it increases the likelihood of going for a break one day. Euromex don't change anything. This is up and down yo-yo. I'm just managing my book around. Still having a short, my base carry going on in this, and see if I can see some rallies to add to it again. Keeping an eye on 1975. If that goes, then we may be on our way back down to low 19s, and that could coincide with a break on the dollar mix. The rest, yeah, this was this Aussie play. Yesterday I sold it through the figure, just grabbed just that tiny bit here, and then today we're already back above. I'm back a little short because I don't like the numbers, and I'm still a believer in the dollar. Think we could see a retest here of this 68, 60, 80, and then see what happens there on the Aussie. And that's about it for me right now, Ryan. Yeah, you've already spoken about the dollar CNH. Not much to add, really. As long as we're above 684, don't change a winning team, and I think we're on our way to 690.
It'll be nice. That'll be very nice.
That is it. Yeah, Brian, I'm a deep buyer on the dollar. In quite a few things. But you have to be selective. Find your right dollar. So look a little bit at what the crosses are doing to find your right dollar pair.
Yeah, and it doesn't mean you can't go the other way, but you know your risk, know which way the wind's blowing. If you're gonna sell rallies in the dollar, know that's potentially the path of most resistance. So maybe you keep your trades sizes smaller, you keep your stops tighter than if you were dip buying. You know, you can always counter. You can trade any way you like as long as you've got a good reason to, and you know your risks when doing so. Right, I'm just going to grab it back quickly. Not got too much to show, but I was keeping half an eye on the Aussie Swiss, just as it was up as subject yesterday. Not that I'm looking to trade it at all, but just a bit of interest. And I think a bit like Aussie dollar. You know, the MAs, daily MAs are pretty close, 58, 65 down here. That fib as well, and we had a look below, but couldn't hold below. So very similar situation to the Aussie dollar yesterday. Got under this fib, got under the fibs, couldn't hold below it though. So again, it doesn't give you confidence to go with a break trade there. You know, I know someone was looking for shorts on this one. Is it good to sell? Well, this is a perfect example. Wait for the confirmation, because we failed, and here we are now. It's support again against this fib and the moving averages. So you know, good price action to watch. Good lesson for everybody. Sometimes if you want to go with a break, you've got to let it confirm, and you want to see this action on the underside of this line for, you know, quite a period, few hours maybe, where you can't get above that level. Gives you then the confidence to get in with your shorts. Right, just quickly, because I haven't done it for a while, and might as well do that for you boys and girls. If you do want to come and join us in the ForexAnalytix platform, the big discount has finished that we ran in January, but you can still grab a 20% discount exclusive to me at Forex Flow by using code FFL20. That discount stays in place for as long as you subscribe. And also, do not forget to have a look at our traders funding program. We've had a couple of people from here and the Face Show coming on board, declaring that on Face yesterday. So good luck to you guys and girls who are joining it. Obviously, some of you boys and girls already in the TFP as well, and working your way slowly and surely towards passing the assessment and getting that funded account. You can check it out on the link there. We will be, I don't know if you saw the post, I think I posted it last week, but Blake is going to be doing a post. He's done a video because he's passed the assessment, and he's pretty much, you know, detailed his journey throughout that. And he's going to be putting that into a post, which is going to be coming out this weekend on our newsletter, first and foremost. So if you don't subscribe to our weekly newsletter, which gives you a ton of analysis to set you up for the week as well, just in case you didn't know about it, that post will be coming out on the newsletter first, and you can sign up for the newsletter. Look for the little panel somewhere on our page there. You'll see subscribe to the ForexAnalytix newsletter on the main site. You can see it right there. He will be detailing all his trades, so every trade he took and the analysis of those trades, you know, how much his average loss was, his average win, number of wins, everything is going to be detailed there, how he passed that assessment and things to look for there. So if you want to get that first before everyone else, sign up for our newsletter and you'll get that all being well this weekend when the newsletters come out. And that's that for today, folks. Thank you very much, Mr. K, for your valued input as always.
Yeah. And thank you, Ryan.
Cheers, mate. And thank you, obviously, to all you viewers for coming and watching us here and supporting us. And we shall see you a bit later on the Face Show. And there's Laura. You were in the TFP, jumped in yesterday. Good luck to you, Laura. Any help you need, you get your access to ForexAnalytix, free access. So, you know, you've got your own chat room. Let us know, hit us up. Anything you need to know about, we're there for you. Thank you very much, boys and girls. See you bright and easy. Yeah, cheers, Kay.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.